Rome did not have a tax office. It had no army of clerks, no treasury officials riding out to the provinces to count harvests and weigh silver into the state's coffers. What it had instead was an auction. Every few years, in the Forum, before the great stone buildings of the Republic, the censors did their work. The Roman state would stand up and sell the right to collect its own taxes to the highest bidder. Private companies bid against one another for the privilege, and the winner paid Rome a fixed price up front, in cash, and then went out into the provinces to collect as much as they possibly could. Everything they gathered above what they had paid, they kept for themselves. This was not corruption hiding in the shadows. This was the system, written into law, conducted in public, blessed by the state. And it made a small circle of Roman investors some of the richest men in the ancient world. The Publicani, Rome's for-profit tax corporations, and the first corporate scandal. To understand why Rome would ever build a system like this, you have to understand how strange Rome's situation was. It was a city-state that had, almost by accident, conquered the entire Mediterranean. Its institutions had been designed to run a single town of farmers and soldiers, and now those same institutions were expected to govern millions of people spread across 3 continents. The Republic had no permanent civil service. It had no professional bureaucracy. No way to reach into a distant province and administer it directly. Magistrates served for a single year and then went home. But the state's need for money never paused. Legions had to be paid and fed. Grain had to be bought to keep the city quiet. Roads, aqueducts, temples, and harbors all had to be funded. So Rome did what every cash-hungry organization with no operational capacity eventually does. It outsourced the work. If the state could not collect its own revenue, it would sell the right to men who could and take its cut safely in advance. The appeal to the Roman treasury was obvious. It received a guaranteed sum of money immediately, without hiring a single collector. It shifted the risk that a bad harvest or a rebellion might leave the taxes uncollected. The state converted an uncertain future stream of revenue into hard cash today and pushed all the risk and all the dirty work of extraction onto private hands. It was, in a sense, the ancient world discovering the logic of privatization. But that logic curdles when the thing being privatized is the power to take money from people by force. The men who bought that job were called the Publicani. They were not senators. Rome's landed aristocracy was legally barred from commerce and regarded it as grubby and beneath their dignity. The Publicani rose instead from the equites, Rome's class of wealthy businessmen who ranked just below the Senate. Merchants, financiers, military contractors, moneylenders, men with capital and ambition, but no political office to constrain them. Tax farming was only one line of their business. The state contracted the Publicani to supply the legions with grain and weapons, to maintain public buildings, to operate the mines and the salt works, to construct the very roads on which the legions marched. Wherever Rome needed something done and lacked the machinery to do it itself, the Publicani were there, bidding for the contract. They also ran the portoria, the customs duties levied at every port and border crossing, collecting a percentage on the vast river of goods flowing through the empire. Cicero himself, who both defended them in court and privately complained about them, called them the flower of the equestrian order, the ornament of the state, and the backbone of the republic. He needed their support, and he feared their power. But the richest prize of all, the one that raised the greatest fortunes and did the greatest damage, was the right to farm the taxes of an entire province. No single person, however wealthy, could front the cash required to tax a whole region alone. So the Publicani pooled their resources and organized themselves into companies called Societates Publicanorum. Partners combined their capital into a shared enterprise. At the top sat a manager in Rome, the magister, who ran the company for a year, supported by a deputy, the pro-magistro, stationed out in the province itself. Below them worked a small army of agents, clerks, and collectors. The company had investors who put in money and expected a return, salaried employees who did the work, and detailed books that tracked every transaction across the Mediterranean. This looked, in its bones, remarkably like a modern corporation, more than 1,000 years before anyone used that word. And here we arrive at one of the most seductive claims in all of economic history. The claim that shares in these companies could be bought and sold on an open market, that Rome, 2,000 years ago, had already invented the stock exchange. It is a wonderful story, and it may even be partly true. But it deserves to be told honestly, because it is repeated far more confidently than the evidence allows. Ancient writers do hint that shares, which they called partes, changed hands, and that some investments were considered safe, while others were considered risky. The scholar Ulrike Maumandier has argued that the Societates Publicanorum operated with features that anticipate the corporation in striking ways. But other historians, among them Ferrario and Poitras, have pushed back hard. They point out that our surviving sources are thin, scattered, and often written by men with no interest in explaining the mechanics of finance. And that the picture of a busy, liquid market in tradable shares rests on reading between very few lines. The honest conclusion is this: Rome built something that genuinely rhymes with the modern corporation, and something that may rhyme with the stock market. Whether it was truly the first of either, in the way we mean those words today, is a question the ancient sources simply cannot answer for us. The rhyme is real. The proof is missing. What is not in doubt is how the money was made, and how ruthless the underlying logic was. A company bid a fixed sum for the taxes of a province, and it owed Rome that sum, regardless of whether or not it managed to collect a single coin. Every denarius it could extract from the provincials above that fixed figure was pure profit. The incentive structure was perfectly designed to produce brutality. There was no cap on what the Publicani could take. There was no oversight worth the name. The governor of the province was often in their debt, or in their pocket, or both. Loans at 48% interest, seized land, debtors sold into slavery. A province could be drained for a decade. And because the company had already paid Rome its fixed sum, the state had no reason to intervene. The money was already in the treasury. The province of Asia was the great laboratory for all of this. In 1233 BC, the reformer Gaius Gracchus passed a law, the Lex Sempronia, that handed the collection of taxes in the richest province of the Republic, Asia, the western coast of modern Turkey, directly to the Publicani in Rome. On paper, it was a brilliant political maneuver. Gracchus wanted to break the Senate's monopoly over the provinces, and by giving the tax contracts to the equestrian class, he built himself a powerful new base of support against the aristocracy. It worked, but in the same stroke, he unleashed the hungriest tax farming companies in the Mediterranean onto the wealthiest and most defenseless regions of the ancient economy, with virtually no restraint. Asia became the great prize of the Republic, and at the same time, its great shame. The fortunes carried home from Asia were the stuff of legend. So quietly was the ruin left behind, town after town, squeezed until it had nothing left to give. Every so often, a Roman with a conscience tried to stand in the way. One of them was Publius Rutilius Rufus, who served in Asia and actually did his job honestly, shielding the provincials from the worst extortions of the Publicani.
For that, he was destroyed. When he returned to Rome, the tax farming interests brought him to trial on a fabricated charge of extortion, the very crime he had spent his term preventing. A jury drawn from the equestrian class, the same class that profited from the tax farms, found him guilty. Rutilius went into exile, and in a final irony, he chose to live out his days in the province he had defended, where the people welcomed him as a hero and a friend.
The lesson landed on every future governor with perfect clarity. Cross the Publicani, and they will end your career, no matter how honest you are. And when Rome's greed finally boiled over, and King Mithridates orchestrated the massacre of 80,000 Romans and Italians across Asia in 88 BC, the hatred the tax farmers had earned was one of the reasons the province rose so eagerly against them.
When Rome reconquered the region, the punishment only deepened the burden. Sulla imposed a colossal war indemnity on Asia, and to pay it, the cities were forced to borrow from Roman financiers at crushing interest. Within a few years, the original debt had multiplied many times over. The Publicani and the moneylenders behind them turned even Rome's punishment of the province into a profit engine, and Asia sank deeper into a debt from which it took generations to climb out. The companies grew so wealthy and so organized that they began to reach directly into Roman politics and bend it to their will. In 61 BC, a syndicate of Publicani won the contract for the taxes of Asia with a bid that was, by their own later admission, wildly too high. Realizing they had overreached and would lose money, they came to the Senate with an extraordinary demand. They asked to tear up the contract they had freely signed and have the price reduced. In plain modern terms, it was a demand for a bailout, a rescue from the consequences of their own greed. The Senate, with the stern Cato leading the resistance, refused on principle. A deal was a deal. That refusal drove the powerful equestrian class straight into the arms of a man who knew exactly how to buy their loyalty. His name was Julius Caesar. In 59 BC, as consul, Caesar gave the Publicani what the Senate would not. He cut a full third of the price of their contract. The first recorded corporate bailout in history, granted not out of mercy, but in exchange for political support. The pattern, it turns out, is very old. In the end, the system was simply too destructive to last. As the Republic collapsed and Augustus built the empire from its wreckage, the Publicani were gradually stripped of their most profitable work. They replaced tax farming companies with salaried procurators, men who had no personal profit riding on how hard they squeezed. Direct taxation, administered by government, gradually took the place of privatized extraction. The great companies shrank and faded, and by the height of the empire, the age of the Publicani was over. But the blueprint they left behind is startlingly, uncomfortably modern. Pool capital from many separate investors into a single enterprise. Separate the people who own the company from the people who manage it. Take on a contract with fixed costs and unlimited upside, and then watch the incentive structure drive behavior all the way to its logical extreme. The Publicani teach us something enduring and uncomfortable. When you turn the collection of public money into a private road to private wealth, the money will indeed get collected efficiently and relentlessly. And the people at the bottom will always end up paying far more than their fair share. Rome learned that lesson at terrible cost. We have been relearning it ever since.